get them.
Welcome into this week's On the Spot. I'm Tony Mulvey, joined by Kevin Hill. Kevin, how are you?
I'm doing great today, Tony. We got some earnings, and we're going to talk about the spot market, the contract market. It's always exciting.
Yeah, and obviously GDP number gets the headline, but we'll probably touch on that next week once we can get a little deeper into it. But starting out, really looking at the market as a whole, when we look at July, right? We've heard it in earnings calls, the seasonally normal July. Kind of seeing that same trend, like the trend is here, and it's no different than what we saw in 2019, even last year, where the market was so high that it probably didn't feel that way. But you definitely saw some softening in the or not softening, but you saw declines in rates during July of last year. You're seeing it this year. We'll pull up a chart here. It's got our van contract initial reported contract rate, so that ex-fuel contract rate, and then our National Truckload Index line haul only, doesn't include fuel. What you see, I mean, this spread between the two. I think that's the important part, is how much lower spot rates are than contract rates. And we've talked about it ad nauseum about this difference in contract and spot, and when shippers are going to start shifting and going through these RFP cycles. I know Luke and I talked about it on with Sonar last week, that really rates are at the point. Spot rates, this spread is where it needs to be to start seeing contract rates roll over. It's just going to take a little time.
Yeah, and I think with C.H. Robinson's earnings reports this morning, they had one of the strongest gross margin percentage quarters in their history, and it shows that wide disparity right now between the contract market and the spot market. We just saw it in the graph. I think it's been trending in the mid-90 cent range, which is as low as we've seen it. So I think you're going to see a resetting of contract rates. We keep on hearing this in our channel checks and from market participants that we talk to. And it's just a process that takes time. And we're getting to that point where we see right there in the graph that contract rates are trending down. I would imagine that's going to take a steeper downward trend over the next quarter, next three months, definitely.
Yeah, I mean, C.H. Robinson, in their report, I mean, they talked about the price that customers paid was up about 2% year over year. So they were already getting those contract rates, but what they pay, their costs, so what they pay to carriers was down about 5% year over year. So you can see they're pushing down rates while they're charging their customers more, leads to that gross margin percentage. We'll move on here to our outbound tender volume and reject index. Kind of shows the same thing, better carrier compliance because of those contracted rates. There is still a decent amount of freight volume moving. It's just down significantly from where it was.
You're exactly right. I mean, I can't say, I think it's the low sixes, 6.22% on national for tender rejections. And, I mean, that's 2019 levels. I mean, that is, it's so completely freight recessionary right now. And the outlook, based on the GDP numbers that came out, is not a good sign. Maybe one of the best signs, you shared it earlier in Slack, Tony, is inflation numbers that came out this morning as well, kind of showing a decline year over year. It was a year over year or month over month of non-durables, durables. We might have hit peak inflation. And if we've hit peak inflation, that's great. The Fed yesterday, 75 basis point jump in interest rates as well. So if there are green shoots, that would be one of the green shoots that I could see for trucking right now.
Yeah, for sure. And then the other one, right? I mean, this is still one, at least on the large carrier side. We'll talk about fuel spreads. I've talked about it with Donnie a lot on the carrier updates, but we'll pull up this chart. It's our rack to wholesale diesel fuel spread. It's at $1.69 a gallon, right at that. I mean, you're talking, that spread is really just this windfall for carriers.
It is. It is a windfall for carriers. You can make a lot of money on fuel surcharges, especially when that spread is blown out to these levels right now. Another green shoot is maybe we're on peak oil. I know that there's a lot of scenarios out there. Gasoline retail has dropped quite quite a bit over the last few weeks. I think diesel will follow. Maybe not as rapidly or as far, but I think maybe we've seen the top of the market for diesel prices as well, which should help out the smaller fleets and the owner operators. But yeah, right now, if you have a fuel surcharge in place and you're buying below retail, you are printing money.
Yep, and this is the perfect kind of example. I mean, the whole topic really of this on the spot, are these fuel surcharges or this fuel spread, ultimately fuel surcharges, driving better carrier compliance? And we'll pull it up. We'll look at Ontario, the largest market in the country, right? Rejections are right at 4%, which I mean is just, they're always low. But then you look at that fuel spread at $2.40 plus cents a gallon of fuel. I mean, it has to drive carrier compliance in those markets.
It does. It must, because like literally you're printing money. I'll say it again. You're printing money on those fuel surcharges. So the line haul rates, and you're going to pick up anything in Southern California to bring it back, because you can just make money off that spread in fuel right now.
Yeah, and I think that's one of the big keys, especially when you're looking at some of these earnings releases, that Q2 maybe wasn't so bad, but they are benefiting from these wide fuel spreads that we've seen throughout the quarter. Awesome.
Yeah, we've been seeing it, and it just keeps on rolling in. So it'll be interesting to see, where it goes from here.
Awesome. Well, thank you so much for joining me this week on this week's On the Spot. Kevin, right now we'll take a quick break, but we'll be back with more FreightWaves Now.